All right, welcome to day 17 of this YouTube mentorship. And remember the usual thing, if you have not gone through the last 16 videos, do how to start from day one and watch down to this point, right? So that you can get a better picture of what we are trying to paint here. All right. So do also like this video because it helps the algorithm to um, make our videos more popular. It's kind of helps our algorithm. Just have to like this video. Just take a moment to like this video and copy the link and share with your friends. Right. This is the day 17 of this YouTube mentorship that have been going on for the past 2 weeks and some days, and we're going to continue to the 30th day. Right. So today going to go into a very important topic, right? Something that I've actually used over the time and that's been a very big benefit to me, right? Very, very simple stuff, something that you really love to know, and I feel that every trader should know, right? I'll teach you guys the concept and then how to apply it, right? This is a free teaching once again. The best thing you can do for us is just to share the video with your friends. Let your friends also be part of this thing that we are doing here, right? So we're teaching you for free. You're not asking you to pay. The only thing you're asking you to do is to simply copy the link and share with your friends. That is not so much of a big task. Just copy and share with your friend. No one's asking you to pay anything. Just share with your friend. That's all. All right. So welcome to today's video. Today I'm talking about a very simple concept which I have actually used. I've seen the power of it. It's called the power of three, right? Very simple thing. The power of three. And yeah, you will really be blessed with this teaching. Now, the power of three is a concept which I learned from the inner circle trader, which is popularly known as ICT. All right, so shout out to ICT. This is not my concept. I didn't learn it on my own. I was actually taught this and I had to back test it, and I've been using it for the past for a long time now. I've been using this for a lot of time. Like I've been using this concept for a very long time. And I can't remember how long exactly I've been using it. And yeah. So now the power of three, it simply refers to three moves or three things that price does when it is buying or selling, right? Every single day, the market does three things. It does three things. That's what makes it the power of three. Right. The first the market does is what we call the accumulation. Then the market always accumulates orders. Right. The market always does what gives a manipulation, right? And the market always what gives what a distribution. This was referred to as the power of three. So these three concepts blended into one is what makes up what the power of three. So when I say power of three, I'm referring to accumulation, manipulation, and distribution. Some people call it the AMD. Right? I can call it the AMD, or the power of three, right? Still the same thing. I call it AMD, that is accumulation, manipulation, and distribution. And we call it what? The power of three, right? So now, what do we mean? So this is a concept that is very widely known or by ICT traders or smart money traders, and it's really blessed if you can understand it. Right. So the power of three is a time and price theory, right? Don't worry, we'll talk about time and price as we continue. Or we have even started it. So this is the first series of time and price, right? We're not heading the time and price because this is why I love the currency market. The currency market is time driven. That is why it's very easy to trade currency than it is to trade synthetic indices or other pairs or crypto or other stuffs, because crypto is always moving. You can't really give a specific time element to it. When it comes to the forex market, the commodity market, the futures market, there's a time component because the actually what the algorithm is based on the time in which the banks open all of those. Because not forex trading is mostly done by big banks, big companies, and all of that. So that is why we have a time element. So the banks open by 8 o'clock. So that is when most of the activities go on in the financial market. By 8 when the banks open up to around 4 p.m. So that is how time comes into play. That is why I prefer currency market to synthetic indices. I prefer currency to any other because of what? The time element. All right. So now in every single candle you see, this is a candle now, right? This is a candle, right? This is a candle, right? In every candle that you see, you usually see what? A higher wick and a lower wick, right? Now follow me now. This is going to be very interesting. So you usually see what? A higher wick and a lower wick, right? See a higher wick and then a lower wick, right? For every candle you see. Now, let's assume that this is a bullish candle. Follow me. So this is a bullish candle now. This is a bullish candle. This is a bullish candle. That's a buy candle, right? A bullish candle, right? This is a bullish candle now, right? Believe me, every bullish candle that you see has various parts. You have what? Number one, you have the open price. This is the open price of the candle. Now we're typing things now in the middle. So we have the open price. So we have the open price of the candle, right? That's the first thing we'll see in every bullish candle. Next thing we'll see is what the low of the candle, right? So you see the low of the candle formed by the bullish candle. You see what the low, right? Then what do you have again? You have what? The high. So the close price and then the high, right? So you know that. So you have a high and the close price. So we'll just quickly label that in so you guys can see what I'm talking about. So you have what the close price of the candle. So the close price. So that is the high. So that is the high, right? And then we have what? The close price. So how about the close price? This is how every bullish candle looks like. This is the anatomy of a daily candle, right? So we have what? The close, right? So this is how a bullish candle looks. The bullish candle opens, forms its low, and then go higher to form its close price. That's what the bullish candle looks like. If you go to your chart now and look at a bullish candle, you see market open, drop down a bit, and then run higher, right? So this is the power of three. So the power of three is trying to explain that there's a reason the market looks this way. So every bullish candle will usually open and go lower first before running higher. So that's what I felt as the power of three. So now, as this bullish candle has opened, right? What do we anticipate? Once the market open, we anticipate the market to drop down a bit. So the movement between this open and this drop down is also referred as the manipulation. So this move here, this wick down, is also referred as manipulation because the market is doing what? Is going the opposite direction. So it's referred as manipulation, right? So the market is doing what? The market is going to what? The wrong direction first. So as the market is going down, this move down is what the effect of what? The manipulation, right? So the market opens, and inside the open, it accumulates short orders, right? The market accumulates sales first before doing what? Going down, right? It accumulates, okay. As the market is going down, it's accumulating what? Long positions. So market accumulates shorts first, run down, and then accumulate longs, and then do what? Distribute higher, right? So the market is always in these three phases. The market usually does what? Opens, accumulates orders, and then manipulates first. It goes down to do what? To seek what? To seek more orders, right? The market is going down to grab more buy orders. That's why the market is going down. It has to go down first to grab more buy orders, accumulate more long positions, and then to distribute it above. So the movement from this manipulation leg to the up, so the effect of what as the distribution. The market does what? It accumulates orders as it's going down. This is what they call the manipulative phase. The market is manipulating downwards. It's grabbing buy orders. It's taking buy orders from different places, from the banks, from the hedge funds, and it's taking out what stop losses. So the market is taking out stop losses, it's accumulating what buys, it's accumulating buy orders, and then does what the market now pushes above to what distribute those what buy orders. So as it's going above now, it's distributing what the buy orders. So this movement up, so they refer to as distribution. So the distribution is what the original intended direction of the market. So the market is bullish. The original move is what we refer as the distribution. Why the wrong move or the false move or the first fake out is what referred to as the manipulation. So this is what happened on every single market. The market is always doing this, always doing this, right? The market is always doing this. So you have to be able to identify this scenario. So this simply states that when the market is bullish, you are anticipating the market to run down first before going higher. And if the market is bearish, you anticipate the market to run up first before going downwards. And so let us now let us flip this scenario now. So let us now this was a bearish candle. Right? Let us flip the whole matter. Let's have this is a bearish candle. Right? So a bearish now. So bearish, that's meaning that this will not be what the was manipulation. This is because of the open price. So the close goes down, and then you now have what the manipulation up. So this is what this if the market is bearish now, it's going to open first, give this manipulation, and then drop down. So this is what we see every single day on every single candle. But we are using the daily candle for this because that is what we are using. So if you are in intraday trader, always look at the daily candle and see if the candle has gone up. So if you are having maybe a bullish bias, wait for the market to go down before running higher, right? So this is a very easy setup. You have to understand it's very easy to spot in the market. Very easy. And this is what frames most of my trading. I'm usually trading in line with this. Always usually trading in line with this, right? So I'm always trading in line with this, right? Always trading in line with this. So you have to understand that the market is what? Either accumulating, manipulating, or distributing. All right. So in this scenario now, the manipulative leg is what the upward move, while the distribution was the downward move. So the distribution is the original move, while the manipulation is what the fake move. And accumulation occurs when the market is what is manipulating. So these two things are happening at the same time. So it's happening at the same time. The market is accumulating and also what manipulating at the same time. So the market is going up, it's grabbing what sell orders. And that is why the market in the market is bearish. Market is always doing what? Giving lower high than what? Lower low. So this lower high is the market doing what? Accumulating orders for sales and then dropping down. So this is what it looks like. Market open, run high, and then what? Drop down. Right. So let us go to the rate chart and try to understand this thing. So let's go to the chart now. So we're going to go to the daily chart, straight to the daily chart, and then we can spot it. So now look at the candles very carefully. Right? Understand it. So let us look at this bullish candle. Watch this. As this market is bearish, what can you see? Can you see that all the bearish candles are doing what? Are print a high first before dropping. Can you see this? All the bearish candles always what? They print a high before dropping. They print a high before dropping. They print a high before dropping. That is how the market keeps dropping. So anytime the market is bearish, the market always what? Give its manipulative leg before dropping, right? You can see this one, run up before dropping, run up before dropping, run up. Now this run up will make people think the market is going to buy. So we already know the market always goes what? The wrong direction first. So it's not always the first, it's not always the first move. But sometimes the market can still go down before going up. So but know that the market usually goes the wrong direction first. As the market was saying, look at we had only one wrong candle here. In all this whole move, only one candle was wrong. Only one candle did not give that move, right? But all the other candle gave was move. Now, still the market is buying. Market was buying, and look at how market was buying. Run down, run up, run down, run up. So you can see the market is doing this same thing on repeat until it did what? It took out this liquidity here, right? The market took out liquidity. The market was still doing the same thing, run down. So that's how the market prints. The market usually does what? Go down before running higher. And that is how that is what brought about the ICT power of three, right? Understanding that the market always runs the opposite direction first before going with the original intended direction. So now, what do you do with this information? So the very thing is simple. So the thing you do with this information is that number one, I'll give you guys live examples as we continue. So the first thing you must do with this is that number one, as the day opens, the first thing you do is you mark what? You mark the New York open price or New York midnight open. So you're not using your broker candle though. So you have to mark it with New York midnight open. This is for currency market. You mark the New York midnight open, you mark it, right? So to set your trading view to New York, just simply come to this chart, click on this UTC. I'm pointing at the bottom right. So you click on time zone, and you set that was New York. So you see New York at -4. So you set your time as New York, so you can get this exam time on your trading view. If you're using MT5, you have to calibrate it and then know what time midnight candle open on your MT5, right? So for Nigeria, midnight time is 5 a.m. So for Nigeria, midnight time is 5 a.m. from now till around November before we have daylight savings time. So it's 5 a.m. So you just simply do is mark the midnight open price. The second thing you do is what? You do what? Number two, you wait for the manipulation. So you have to wait for the manipulation. So the second thing is you wait for the manipulation. This is a step-by-step approach to trading it. You wait for the manipulation. So when you're waiting for the manipulation, now what do you do next? Now wait for what? Your confirmation for what? Distribution. So wait for what? Wait for what? The distribution confirmation. So wait for what? But the third thing is what? You wait for distribution confirmation. So wait for what? So wait for the market to do what? To give what? That confirmation that it wants to distribute. So I mean, if you want to wait, see what? You want to see what a break of structure. You want to see a structural shift. So this is simply doing what? Waiting for a structural shift. When the market give you what? That structural confirmation, the market is about to move, right? You have to wait for mark the midnight open, wait for the manipulation, and then what? Wait for what? A distribution confirmation. Those are the three things you do with the power of three. So now let us do that. Let us look at yesterday's price action, right? Let us look at yesterday's price action very quickly so I can understand this concept. Let's look at yesterday's price action very quickly. Let's go to yesterday's price action. All right, so yesterday was bearish, right? So let us see what happened there. Okay, market has been bearish. Market has been trading lower, and then what happened there? We hit this imbalance, right? So we hit this imbalance. I have to always look at the structure of the market. So we hit this imbalance here. So we hit this imbalance. So we hit this imbalance here, right? So we hit this imbalance right there. So we hit this imbalance. So the market is dropping from that imbalance. So we are bearish, right? Market is doing what? Is breaking lows, breaking lows. So we hit this imbalance. That means we can anticipate some sales, right? So let us see what happened yesterday. Right, let's look at yesterday. So market wanted to drop. So we simply go to what? A lower time frame. Maybe prefer the 15 minutes. Let's see what happened yesterday. Yesterday was Tuesday, I think. Yesterday was Tuesday. All right. So what do we have on Tuesday? On Tuesday, you mark what the midnight open price. So midnight open price is where? Here, right? So this is the midnight open price. So this is the midnight candle. Let's go to the 5-minute chart so you can see clearly. So this is the midnight open price. What happened? Can you see? This was Tuesday, right? So what happened there? Market was first the market has opened, it's bought a little bit, just pushed up a little bit, and then what? Dropped. All right. So this is what I'm talking about. The market actually bought a bit for the what? Dropping. This was not a very good move. I don't really like that price action. It didn't really move up as I wanted. All right. You have to backtest this information. Let's look at $0 instead. Let's look at $0. I don't really like GE price action. Let's look at the $0 instead. Because I was trading EU yesterday. So let me talk about EU because I was trading EU yesterday. This is EU. All right, so EU was bullish yesterday. Actually bought EU yesterday. Why? Why are we bullish? Because what we have what? We had this structural shift. It's kind of break of structure here. Market is kind of bullish. Market broke down. Then what? We are kind of in a bullish range, right? So we have this area. So that's it. So let's see. He was kind of bullish yesterday because why was kind of lower time frame break of structure here. Market has closed above this high. Market has come down to tap into what this area. Market has come to tap into this area, right? This last downward. So market is kind of giving a bullish setup. So let's look at the lower time frame. Let us see how why the market bought after printing this long week to the downside. So we simply hit the 15 minutes time frame. You have to backtest this information very well so you can get the better handle what price is doing. All right, so let's see EU. Let's take this out. All right, let's take this out. Where is the drawings? So let's look at the midnight candle. Where's the midnight candle here? So EU is on. This was Tuesday. So look at it here. So this is the midnight candle here. Can you see it? The market ran down. So we have what our manipulation now. You can see that the market was the manipulation leg. So did we have a confirmation here? Yes. So we have what? A break of the market now broke on structure above this high, right? So this is very clear. I took this trade yesterday. You can check my Telegram community. I took this trade. I took it. You can check my Telegram and my Twitter. I actually took this trade. Check my Telegram so you see there. So market actually gave what the manipulation leg. That is number one. Number two, so what the confirmation. So market gave what that confirmation, right? Number one, we marked what the midnight candle, which is what this candle. Market ran below and we are bullish, right? Market must go down if you are bullish first. Market ran down and gave what was a bullish break of structure. So what do we play? So I played this other block. Very simple trade. I played this other block. This other block. So very simple trade. Other block. Remember what I taught you about ROTO. Go and watch the video on return to other blocks. I talked about this setup. The market's breaking and coming back towards another block and take out an inducement. So our inducement here. So our inducement taken out here. This is our inducement. Remember that first block is the inducement. Remember the video. Go and watch these videos. Watch the videos that were made before this one so you can understand what I'm talking about. It's not nice that you're watching this video, you have not watched the previous ones. Watch the video on inducement, watch the one I talked about other blocks. They are all in this October mentorship. Go through all of them. Right. So we had that break of structure, we had this other block, and then what markets came out there, I bought there, and what happened? Market was distributed. So we had what the manipulation leg. This was the manipulation leg, this move here. Manipulation leg, right? We now had was the confirmation. We had a confirmation by this move up, and then how was the distribution to the upside. So this was what we call the distribution. So market was gave the manipulation, gave what the bullish confirmation, and then what gave what the distribution, right? So that's basically what I'm talking about, right? So that is basically what I'm talking about. So you have to learn how to spot this on your own, right? So I will just give you guys one example. This is one example I want to give you guys. So I want you guys to go to your chart and then identify these things, right? Go and look for these things on your on your own chart. It happens on cryptocurrency, it happens on gold, it happens on silver, it happens on oil, it happens on EU, all the currency pairs. I don't know about synthetic indices, but this happens on all the charts. All right, so I want you guys to go and backtest this information. Pull up your trading view, look out for New York midnight, and then do this, right? Don't forget to follow me on Twitter for more information so I can learn more real-time updates. Join my Telegram community with the link in the description. Join the Telegram free community. So I would love to see you guys in tomorrow's teaching. Have a wonderful day. So cheers and God bless.